Hi, this is Randy Finney with Right Side of the Chart. This is an early session update for Tuesday, March 8th, 2022. What I'm going to do in this video is go over, just reiterate my price targets on the indexes, both near term and longer term. Longer term referring to trend trades, position trades. Near term, again, what is it? Near term is what's expected to be hit in the coming weeks to no more than a couple months here, and longer term targets could take many months, even a year or more to play out. We'll see. We'll see how things unfold. Just keep in mind that stocks tend to fall a lot faster than they rise, especially after a lot of excesses have been built into any particular security, whether it's a stock, an index, a commodity. So factor that in mind as well. In other words, some corrections can take longer to unfold. Some are once either a bubble pops or excess imbalances are corrected. All right, I'm going to start out here, and we're only going to go over weekly charts, and I'll do this for you guys as well as I'm going to take screenshots of each of these charts after the video and post them in this post. So by the time you get the video, you should have these charts as well. And I tweaked a couple of the targets on a couple of the charts. I'll start out here with QQQ, which has been my go-to. My go-to index, heaviest weighting on that, and that may roll soon. I shorted last night. I was studying the charts late, burning the midnight oil, and quite often I focus on three main indexes. You guys, if you follow me, QQQ, SPY, or the Nasdaq 100, the S&P 500, and then the Russell 2000 small caps. But of course, those are not the only indexes out there. In between that, big spread between the large caps, which are multi-billion, and even a select handful of trillion-dollar companies. As far as market cap, that's what's in your large cap indexes, which are QQQ and SPY. Then you have the other end of the spectrum, the small caps. Now there's micro cap indexes, which are smaller than the small caps. There's ETFs that track that, and then there's of course the big void in the middle, which are big sweet spot, and usually long term some of the best performing stocks are the mid caps. I do cover that from time to time, and I'm going to share targets because what stood out to me last night is I think there's more. Possibly more meat on the bone on a short on the mid caps and the small caps, and maybe even the large caps here. So I'm going to get to that chart in a second, and like I said, I'm starting to scale in there, add a little exposure on the mid caps as well. So now I'm short the Nasdaq 100 mid caps and small caps. All right, here's the targets. I'm just going to go over them quick and reiterate what's happened here. We had sell signal number 1 here, sell signal number 2 there, multiple sell signals up top, and then along the way, got to be easily a dozen or more objective short entries, such as kickbacks to broken support. Once we broke support, kickbacks to the moving averages, kickbacks to key Fibonacci retracement levels. Not once but twice we did that, and then even as recently as just the other day, kickbacks to small resistance levels on the 60-minute charts. So we're getting in that point. Part of the way I trade and what I try to get out to you guys is reading the ebb and flow and trying to predict not only where we're going in price, that's what I'm going over today, but how we're going to get there. And where that comes in, for example, when I gave you that objective short level yesterday on the futures, when pre-market, which of course I said QQQ or SQQQ as well, or TZA if you're trading the ETFs, those were really small, relatively very minor bounce back levels, and there were very minor resistance levels, and that's because at this point we already had our consolidation period where bulls still think it's just a buy the dip opportunity, and you have that consolidation. You had that bounce off the first target, which was to be expected the day we hit it. The day we hit that initial low on the 28th. I'm sorry, this is a weekly chart. I think it was the 24th. A bounce was expected. So where I'm going with that is now we're in the stage where I believe, if my read is correct, we're going to have that more impulsive drop, and any kickback rallies are going to be smaller and smaller. In other words, I think we've reached, and we're not opening the floodgates yet, and we need to take out those recent lows, but I think we've reached what I call the point of recognition. That's what I call it, just when, the majority of market participants are always bulls, they're always buyers. That's just any point in time. I don't even care if you're in a bear market. You have most people are just inherently bullish, looking to buy stocks, and even if you're in a bear market, they're looking to position where to get into Apple, where to get into this and that. So point of recognition is when the masses, or at least a good majority of people out there, realize, uh-oh, something's different. This isn't just a run-of-the-mill correction, buying the dip opportunity as it was here, 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 and I thought it was here, then I thought it was again, and now, things are different. Every time I keep buying the dip, I keep getting underwater. There's a positive for a second there, and then boom, another leg down. And so again, a point of recognition is when you finally have that shift of buyers versus sellers, the dynamics, the supply-demand dynamics change. And I think that's where we're at. We'll know in hindsight. Only in hindsight will we know. And if it happens, it usually happens pretty quick. There's capitulation. Dip buyers give up at that point. Reluctant short sellers are flexible traders like myself that are just as comfortable going short as long. But those that were hesitant, didn't want to short here, because said, oh, it's an uptrend, why are you going to short? And then they didn't want to short here. Now they want to short, they'll pile in too. It's like sharks smell blood in the water. Okay, so that is my logic, my thinking, and that may change on a day-to-day basis. I may tell you, hold off. But that's where I think we're going. And, we're early in the week. We'll see if it happens this week. But see if it happens this week. I mean, continue on down and hit my second target in relatively short order. That would still be where we're at today. We're down 1.2% on the Qs. My next target is about another almost 7% below current levels. And, I think there's a good chance, if I'm correct on my read, we'll hit that this week or early next week. Sometime next week. And then, all right, just to wrap it up, T3, these haven't changed. I've maintained these targets since we were coming off the highs here. This is the weekly time frame again, and where I'm really focused on, because I've turned into, instead of hit and run swing trader, trading corrections and bounces back here on 60-minute charts. Now I'm focused more, or at least I'm speaking to that trend / typical swing trader hat that I wear. I'll wear a day trading hat as well. I'm in and out. 90% of those I don't, it's just too fast. I make a decision, it's in. By the time if I were to get a post off, it's you can't follow a day trader. It's like trying to follow, learning to be a quarterback and trying to follow Tom Brady in his footsteps during the game, and and reacting as quick as he does to, where he's going to throw the ball or if he's going to tuck it and run, that kind of thing. It's just you can swing trading. I can get out my thoughts in advance or in real time when there's opportunities, and day trading is not very conducive. So once in a while, I'll share some setups on a short-term chart for you. All right, back to where we were, 299.15. So we're going to call that roughly 300. My strategy is, I don't think that's the final stopping point. If I'm correct and we get there, as I said many times before, simply the fact of being right as each of these additional targets get hit, what it's going to do, it's going to roll over longer term indicators that have yet to roll over. Right now, we had, sure you guys probably saw the headlines, officially the S&P 500 just recently entered correction mode, officially a drop of 10% or more. And then the NASDAQ 100, which again, I've been clear all along, has been my preferred shorting proxy, just hit bear market territory. And I think it was on the same day. So that just shows you the benefit too of the takeaway is, I said it in the beginning, why short the S&P 500? You're shorting defensive issues. You're shorting utilities and healthcare and consumer staples, things that tend to either go up or not fall as much in a down market, whereas QQQ is more concentrated in the overvalued high growth tech stocks, and they're more sensitive to a change in the economic cycle. And as such, you got double the returns if you shorted QQQ off the highs than you did on S&P 500. Now that's not going to last forever. There's going to be, and that's why I'm doing this video, I may start to gradually take profits on the QQQ shorts, shift them over into any other individual stocks, sectors, commodities, That's all part of micromanaging a portfolio, is balancing out. But I just wanted to reiterate these targets and also share my strategy if and as we approach T2, depending on how things look at the time. That is a myriad of factors. I can't even cover them all right now. It is, what does short-term charts look like, 60-minute charts? What does the S&P 500 look like? The small caps, the mid caps. What are treasury bonds doing? Corporate bonds, junk bonds. I look for cues in the bond markets and interest rates. A myriad of factors will then let me decide whether I want to cover and do what I did back here, where I reversed and gained the bounce, or sit tight. Being that the crash warnings are still out there, I think that we still have an elevated risk for a crash. And by the way, what we've seen is not a crash. It is a run-of-the-mill correction. I've commented on this many times in the past. I think the mainstream media, just because how things are in the world, people tend to use what's already in existence, and I think the old definition of a correction in the stock market being a 10% drop off the highs and a bear market 20% is antiquated. With volatility in a Fed with tremendous, that is, does everything in their power to manipulate the stock market, print money. We've seen volatility increase. Growth rates on companies have increased. The biggest companies on the stock market today are growing at much faster a rate than the market leaders of yesteryear. The old AT&T, Ma Bell, and Xerox and IBM and companies from way back when. And so my point being, the bull markets are going to be much bigger. The bear markets are going to be much bigger as well to the downside. And you're going to get corrections, what I call corrections, that are going to exceed 20% along the way. And we've had quite a few of those, including the 36% drop when COVID hit in the S&P 500, which was less than that in the NASDAQ 100. Again, as I made the case many times, I view that as being a correction. So where are we at, and where am I going with that is one option if you come down here, especially if you got your eye on the prize, and I think the odds are pretty decent now. We're going to hit my longer term targets, which are effectively roughly a back test or a fallback to where the stock market was before COVID hit. That's where I think we're going at minimum ultimately, and ultimately is either going to be this year or next. Probably this year. I would put pretty high odds it's going to be this year. Anything's possible. And that will be, I already, way back here, I measured it out for you. It's going to be about a 42% drop in QQQ off the highs, roughly, if that's hit. I have this 235 is roughly the price level, but I also have a couple of alternative primary uptrend lines, and you can see those uptrend lines come off the bull market lows back in '08 for the NASDAQ 100, and then the subsequent tag, which was a little higher in March of '09. That's where the rest of the indexes bottomed. And so that's where I think we're going. So by saying keep your eye on the prize, if you want to, give it wide enough stops, you can swing that down, and and that's what stops are for. In case I'm wrong, at this point, we really have little business going back above my former first target, which is about 342. But I've made clear, ideally, I want to see on a weekly basis. I don't want to see a recovery, a solid recovery back above the 40-week moving averages. And the higher you go up, that's the thing about stops. The wider your stops are, the more profits you're going to give back. Anybody that's taken any of the short trades on the site right now should be profitable, from extremely profitable in the NASDAQ 100 to at least somewhat profitable from the last objective short add-on. And keep in mind too, it gets less and less objective. The stock market or any security, when it falls, it's like a coiled spring, or a rubber band actually is more of the analogy, especially if it's falling hard. That rubber band's getting stretched, and the snapback rallies are going to get more and more powerful. So that's why I'm going to get the questions. I always do, and that's what I'm here for. But hey, where's the next place to short? I'll point out the levels because some people are micromanaging, some want to get in. But look, the closer we get to these additional targets, the less objective it is. The best shorting ops were up here, here, here. Now, look, it's all about risk reward. So, if you're looking to the next target of another 7%, or if you're going to hold out to these longer term targets, you have as much as, say, another 28%, 27 in the S&P 500. So yeah, you could short here right now today and use let's say a 9% stop loss. That would give you a 3-to-1 risk reward ratio, right? And 9% is 1 unit of loss to 3 units of downside. 3 units of profit potential. But ideally, you want to strategically enter those positions on bounce back to resistance like I gave you yesterday. In this case, there's a potential downtrend line here on the weekly. There's that rough support now. It's been traded through a few times, 342, and of course some moving averages. All right, moving on to the next one. Here's SPY. I did cleaned up and updated my targets on SPY for you SPY traders, because what I think we'll see is at some point, we're already, hot air is coming out of where it needed to come out of, those high fluting tech stocks. And that's why the NASDAQ 100 is down twice as much as the S&P. It's fallen twice as much from the size. At some point, you're going to reach, I don't want to use the word parity, but you're going to have let enough of the hot air out that there's, compelling, valuations start to become a little more compelling. Apple, Microsoft, Amazon, they're not going away. They're going to go down more, I believe, but there's going to be plenty of counter trend rallies, and at one point there's going to be a nice tradable. Even if it's a bear market rally, it can be powerful, and that's what I love about bear market rallies. They usually are. You probably get 20% or more when it's time to go long. And that's what I'll be looking for. But where I was going is, at some point you're going to start to see, and we see other sectors that have been holding up in the S&P 500 breakdown. Like yesterday, I told you I wanted to see the financials break, and they did. They're gone now. They took out my key support level right here, and they're coming up on the next support. But I still maintain my targets I laid out way back here, and we had that breakdown here in that sell signal. We hit my first target, meandered around sideways, made a marginal new high, and so there's more downside. And so why did I point this out? Well, the one thing about the NASDAQ 100, it's not as nearly as diversified as the S&P 500. It doesn't represent, there's no representation or minimal, if any, of the the financial sector. It's a concentrated sector with mostly tech companies, about half tech. And so now what you're going to see as these other sectors that have held up start to break down, you'll probably see a closing of the gap and that outperformance to the downside of the NASDAQ 100 and the S&P 500 either playing catch up. It may not reach parity, or it could. And so therefore, micromanage those positions, and you might want to start shifting some money over into shorting the S&P 500 or other things like I'm about to get to here in a second, like the mid caps. All right, so going back to that, I just wanted to update the targets there. Let's see. You know what? No, I thought I did that. No, that's no wonder. That's a daily chart. Here, I did do it. All right, weekly chart. Back to the weekly primary uptrend line right here. This uptrend line's off the COVID lows. It was already taken out, as was that trend line. So we had a breakdown, back test of the first trend line, then a breakdown and back test of the secondary trend line, and then it's been nothing but a correction since. Hit my first target, put in a bear flag, bounced perfect right back to that key 451 level. That was at the bottom of the trading range when we broke out the all-time highs. Failed it there. Again, I know I talk like a geek. I love charts. I love technical analysis, and so far this correction's playing out perfectly. All these little, big red candle down through there, but it hit the 200-day moving averages, so that's where we had the initial little consolidation there for about a week or two. Tried to break them out, went down, hit my first target, did take out the 200s, but hit my first target, and that same very week closed back on them. So successfully held that for the second week. Remember that green candle, there's the top of it. Then you held it again, and boom, the 200s gave way, and once you broke down, they were back tested. So it was like that, Support one, oops, didn't mean to move that. Support one broken, and then back tested. Support 2, the 200 days broken and then back tested, and then a rejection. We're moving lower, and now I need to see this level go 415.50ish, And then when that happens, there's my next near-term target. This is what I was talking about earlier. It's a little beyond where the bear flag measures to. The measure target for the bear flag takes you a little above that, about 400, 486. We'll round that to 401. So you can, target, let's say 394.50 up to about 401 would be, the next target zone for the S&P. If and when that's taken out, my expectation is for a bounce off that level on the initial tag. It may or may not happen. Again, that's it's not as strong as it was back here, because again, we're going to enter that, what I believe, that point of recognition. We could open the floodgates, and selling can beget more selling as margin calls are hit. Remember, we're coming off record high margin interest, and the vast majority of that, almost all of it in the bull market, is longs that are long on people that are long on margin, not a bunch of shorts. You don't have high short interest at the top of a bull market. You have a ton of longs, and those longs because hey, buying, everything's going up. I made X on my S&P 500 index fund last month. Why not buy twice as much? My broker will give me margin and let me buy a lot more than I actually have money in the account. So that's what margin is, and then it gets unwound, and that's why one reason why bear markets are so powerful. It's happened every time. We've had two big ones in the last couple decades, 2000 to 2002 and then 2007 to 2009. Both of those, you can look at the margin charts. Just Google search NYSE margin interest. You'll see the charts. You'll see it at peak highs, all-time highs, and then boom, that margin bubble burst. And that's why there's such a impulsive, relentless down, especially once you get that third wave down. You always have an initial wave down. The Elliott wavers know this, in a primary 5-wave cycle. First leg down, counter trend rally, that's wave 1, 2, and then P3, the primary wave 3 is usually your biggest. So that might look something like this and take us all the way down here to my long-term target. Then you get wave 4 and then 5, and that's if we get a perfect 5-wave primary wave count there. There's other counts. I'm not a big Elliott wave guy. It's a bit too subjective in hindsight to revision for my taste. But you overlay some of the big moves, and quite often you'll see it does work out. And then the corrections typically are ABC moves. So, maybe this is what that is, an ABC correction in a bull market with a lot more upside to come. We'll watch it, and then we'll start being wrong, or I'll start being wrong, if and as each of those nearby levels are taken out. All right, back to the targets. Near-term T2, this is 394.56. That's what I think gets hit next, especially if we take out the recent lows, which we've still yet to do. We come very close. And then I've cleaned it up here and added longer-term targets for the S&P 500. Again, if you want to keep your eye on the prize. Long-term T1 would be right about 354. And then next below that is, so this is more of a target zone. And if and when we start to approach it, I'll zero in on which target, and that'll all depend on how the charts look at the time. Are there divergences forming? Is there any potential indications of a selling climax, which would be a big surge in volume, during a pretty straight down waterfall type sell-off? Any other indications? Are there other indexes and key stocks that are hitting support around that time or approaching support? So there's a lot that goes into calling a bottom, just like calling a top, and I can only do that if and when we get there. And again, there's still work to be done, and that is, of course, take out today's lows. So this is my long-term target zone, you'll call it, on the S&P 500. It's 354, call it 354 down to 325. And what that would represent, to kind of give you a scope of the bear market I'm looking for, that would be from the highs, it would be about a 26 to 32% drop, which is really not even that bad of a bear market. It's really run of the mill. And right smack in the middle, that long-term T2 second target's at 339, is the previous highs, that what I call the post or pre-COVID highs from February of 2000. So those are your levels there. And now let's move on to, I'll get to the mid caps last because that's a new one. I've already shared IWM with you for quite a while, laying out this. This is what I had, is just I had it listed as target. my price target at the time. It was a sole price target when we were still within this multi or year-long trading range. I said we'd get a major sell signal if and when that bottom of that range broke out, which I expected based on the everything that had happened up to that point, the negative divergence, the overshoot and failed breakout, aka bull trap of that trading range. Then when we got the sell signal, it was textbook. You couldn't ask for a better sell signal. What you want to see is a impulsive drop, and that's you got a big red candle down through there and a solid close below it. You hit that first target. The time QQQ just hit my first target, so then I added in this one as the first target, 192.15. We hit it, bounced. Then right here, highlighted that as probably the best shorting op you're going to get when we back tested the 209 level. And then that was so far. Now we came back down. We basically had a second test to that low recently, and so that's it. We need to break it. This is kind of simple stuff. I hate to oversimplify technical analysis, and there's no guarantees, but this is it. You have a trading range here. So, sell signal, break on the, and a downside break would be your most probable. An upside break, obviously, if it's a solid break and sustained break would have been bullish. But the charts indicated otherwise, and right now I think the charts indicated downside breaks most likely, but it hasn't happened yet. And when you get it, well, that's what you want to look for, a solid break, especially a weekly close. Remember, a weekly chart doesn't matter what you do intra-week. These are just candlestick shadows, intra-week moves. You need to see a weekly close. But I can tell you, if we get it, will probably waterfall down, so you might want to be a little early in on it. If you wait till Friday 4 p.m., you could be all the way down here to T2. So you just kind of have to be flexible and look at everything else at the time. Is the S&P 500 breaking support too? Is the NASDAQ 100 breaking support? Are the mid-caps breaking support? And if they all are, you're probably going to get that wash down move and then hit that target, which is 171. That's going to correlate to a total correction or bear market at the time of about 30% off the highs in the small caps. And then what I did today, and that's why I'm doing this video, and I'll get these charts out to you again, I added a potential third and fourth target for you, which may come into play. So again, because if we get to T2, it's going to be I think a great buying opportunity. It's very good support. That is a nice support level. You have major reaction highs, not just little squiggly in the, along the uptrend. These are major reaction highs, major because each one was followed by a big drop, and so that was big resistance, and then you had a breakout candle right there. You gapped above it, huge move up on the weekly. That's a big gap, and then you never look back. That is on a 10. That on a scale 1 to 10, that's a 10 for technically significant events. So this is a big level. There's no guarantee we bounce off it, but the odds are pretty good. So again, depending on if and when we get there, I'll be looking to cover and most likely reverse my IWM shorts. But if something else happens and and the sky is falling and we're approaching it, I could just set trailing stops, tighten up my stops, and let it run, because what can happen as well is we may overshoot it with momentum, what I call momentum fueled overshoot, if we're waterfalling down to it, and then come down and maybe hit here or close to it, and then bounce back and close the week on or back above it. So that's one reason why when you approach a price target, especially if you have a lot of momentum heading into it, if you tighten up and run a trailing stop, you could actually milk a lot more out of that trade, and than just taking profits there. So that's it, and this was, remember, this is the measured target for the bear flag. It almost perfectly aligns. That was the bear flag right here with my second target. So there's your additional targets. And then last but not least, Mdy Mid Cap. So this is the one I was looking last night, and I saw a very nice, almost identical pattern to IWM. By that, let me show you what I see. Here's what I see. I see a, just like IWM, actually it goes longer, a year-long trading range. I see a false breakout. I see a divergent high, right? I see well-defined support at the bottom of the range, right at about 462, right? And again, let me show you IWM. There's IWM, but IWM broke down, triggered a sell signal there, took out that trading range. So IWM looks to be ahead, and then I see a well-defined support level below. However, from where we're at today, this is why I'm shifting some money over to mid caps. from where we're at today, if my second target is hit on IWM, or that 171 target, you have about a 12.5% drop, right? Go back to the mid caps, MDY. So this, not T1, T1's in the middle. It's comparable to what we already hit on our IWM. This is the same right here, the comparable reaction highs back from the pre-COVID highs in February of 2020, and then that peak high in 2018 before the big drop. And now that, if I measure that from where we are right now, 462 on the MDY, the mid-cap ETF, I have it at a target zone, runs from 383.50 down to about 373.50. And so that, if hit, is going to be a drop of 17.5 up to about 19.5%. So more meat on the bone on the mid caps than the small caps if that target is hit. So food for thought, and also a trade idea for you right there. What does it need to do? Well, like everything else, these recent lows, we hit, tested that level, inter-week stick save, boom, another one, inter-week stick save, but those reaction lows are still valid. So really it's low from a week before last, and that is a low of 452.89. Like I said, we gotten close enough. I don't think I'll be surprised. It's still, look, the ball is in the Bulls' court right now. They need to take it and run right here. If there are enough buyers in this market, I just speak metaphorically. I'm not, calling out anyone, not name calling a bull or bear. I'm just speaking buyers versus sellers. If there's plenty of buyers left in the market, including but not limited to the government, it doesn't matter. I'm not going to cry spilled milk. I'll tell you when I think there's maybe government manipulation in the market. And the government's never made any tried to conceal the fact. I mean, the Fed just outright blatantly, going back to the days of, before Bernanke even, I know Bernanke said it, they clearly acknowledged they started, Bernanke did back in the financial crisis in '08, quantitative easing and the zero interest rate policy to a large extent to force money out of safe haven investments, treasury bonds, fixed income investments, and force it into the stock market in order to buoy the stock market to create consumer confidence, because what they call the wealth effect. Stock market goes up, your 401k goes up, you spend more money, and then that has a vicious cycle on the economy. And of course, we all know after 1987 when the crash was set up, then they set up the PPT, Plunge Protection Team, which is officially called government's financial work group, something along those lines. You can Google it. And they were supposedly directed, or it's a private organization, only answers to the president directly, no public information there, but supposedly they can use whatever means it takes, including not limited to buying stock futures to buoy the markets. But I'm also a believer of, if you initial reactions, Randy, why fight the government? Why fight the Fed? Well, that they implemented that in 1987, and I just direct you to March of 2000. Look at what the Nasdaq 100 did from that point, or even the S&P 500. Go back to 2007. October, look what happened to the 55% drop in the S&P 500 from that point over the next year and a half. So there's only so much. As big as the federal government is, as big as the banks are that they make commission to support the financial markets, they're not big enough to overwhelm an entire world. Individual investors and professional institutions that are selling positions. So I believe they can only delay or temporarily postpone the inevitable. Stock prices will ultimately go to where the fundamentals say they need to go, and actually take it a step further. They're going to swing. The pendulum's always going to swing to the opposite direction, just like it did in 2000, the dot-com bubble, 2007, the housing bubble. This in many sectors, not the entire stock market, but it was frothy, but many sectors. And just like on the downside in 2009, stocks were dirt cheap. They were priced for oblivion. And same with at the COVID lows, big drop, things get cheap. And so I just want to say that, what I said a minute ago, the fundamentals are going to take stocks to where they need to go ultimately, even if for a long period of time they get ahead of themselves, overvalued, or during a correction or bear market they get undervalued. But the thing is too that the pendulum almost always swings to the extreme or to the other end of the spectrum, meaning they get overdone at the high end of the market and then oversold and overvalued at the bottom. And that's why when a bear market's over, the gains are usually explosive. And just like when a bull market is over, the drop is usually pretty darn fast. And it starts to snowball too. COVID was a little bit kind of different animal because everything happened pretty quick. All right, so you can either listen to this whole video, or I'll put, like I said, I'll post these charts out there. These, like any price targets, may change. I haven't had to change any of my targets on QQQ, the primary targets, or SPY. I added a few for you today, and this is a new one here. So this is how I would see this playing out, something along these lines. T2, I'm just leaving for now. When I say potential, it's just saying that right now. This is my thoughts, that if I had to set an OCO order and walk away, OCO orders are the bomb. Look into them. OCO means one cancels the other. Some brokers call them OCA, one cancels another, and that is when you buy a position. Let's say that I had to, I was going on a mission to Mars, right? And I wasn't going to be back for at least a few years. And I wanted to trade the MDY, but I had no way to trade it. I would short it here. Let's say I get, we take out the recent lows. Let's just say I short it now. All right, so I shorted it 461.46. And an OCO order, I put an order for a stop loss right here. Let's say it, just around that 500 level. And I'm targeting let's just say 380, right? Okay, so it looks like a decent RR, nice risk reward. I'm losing maybe 1 unit of loss for every 3 units of profit I'm looking at. And then an OCO order, I do it good to cancel, and it tells my broker, that order says, all right, if MDY crosses above 500, stop out. Cut my losses, and that order will be triggered, and then it will automatically cancel this other order, which is a buy to cover order right here to cover the short when my target's hit. Likewise, if we go down, and it doesn't matter how we get there, as long as we go down, hit it, that order's hit, and then this one's canceled. And so that's right now where I'm going with that, is that would be roughly what I'd be targeting. 380 to the downside with a stop somewhere, somewhere above there. I might have to sharpen my pencil. I can see some price resistance on the top of the zone. Remember, that was the trading zone with a false breakout there. And that's it. So this is what I think happens. If this happens, take out the moving average, and that happens, then hey, I was wrong. And move on to the next one. There's always another trade around the corner, and the key to investing and trading is one thing they say, it's cliche, let your winners run, cut your losers. Yeah, to an extent, but also, take trades. Mine is just have a trading plan. Before you go into any stock, what are you going to buy or sell? Why are you going to buy and sell it? Okay, where are you going to take profits if correct, and where are you going to stop out if wrong? And that's your trading plan. Set it and forget it. And the OCO orders, the benefit or the beauty of those is they give what I can tell you right now from my own experience and from talking to many others, what most traders lack and where they fail, and that's discipline. They second guess every move against them. They might have had all intentions to target a drop like that in MDY, but they counter trend rally. They're hearing the news getting pumped on the financial media. The Fed's going to do this, Biden's going to do that, and something scares them out of their position. Or maybe they just, they see the big drop and they're up so much when their first, that halfway point target is hit, and they say, oh, I've got to book profits. I've been battered on losses for months now. I'm going to take that gain while I have it. And then by doing that, what you're doing, if you were allowing this much loss, you're reducing your RR to about a 1-to-1. And unless your success ratio is well above 50%, you're going to lose money if you're risking $1 to make $1. You can do that if you can bat over 500, but if you're batting 300 and you're risking $1 to make $1, meaning that 30% or so of your trades are profitable and the others aren't, you're going to lose money and you're in the wrong business. So that's where the OCO orders come in, and they take away that mental anguish that I have no doubt a lot of you are feeling in this kind of volatile market if you're trying to game it long or short. All right, guys, a long video, and I promised you short ones. Today, again, if something big happens before the close, I'll get one out to you before the close or some charts with comments. But when I do a midday update like this, something long, and there's nothing different, nothing's changed since yesterday's video, I'm not going to bother putting out a 5, 10, 15-minute video. But again, if there's anything significant before the close or before the market open, that's when I'll fire out charts to you or a brief video. For now, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.